according to wealth management firm Open Air Advisors. And while inflation has come down recently, not everyone has felt relief just yet.
Despite being stretched, 70% of folks expect to give more than what they gave in 2022.
Patience.
It could be a wonderful tax tool. That could be a wonderful part of your overall plan to reduce taxes in your retirement planning or your income planning for the year.
Meaning this, depending on the contribution, you could qualify for a deduction on your income taxes of up to 60% with your donation. But the amount you donate has to be greater than the standard deduction. This year, the standard deduction is more than $13,000 for those who file single and more than $27,000 for married couples. John Lawton, a financial planner with Open Air Advisors, says one recommendation he gives to his clients is to bunch their giving.
Rather than giving the same amount every year, a lot of times what we'll do is we'll skip a year and then do two givings in 1 year. So we're bunching those together with the intention of trying to get over those limits.
Another option, if you have investments, you can donate a highly appreciated stock or bond, and you can do that in place of money.
If you were to sell it, it would be a tax burden for you. When we donate that money away, that eliminated the tax burden for you, and the charitable organization doesn't have to pay the taxes on that appreciation of the stock.
There's also something called a donor advised fund. This is where you create an account specifically for charity. You can write off a donor advised fund up front if you itemize deductions. And if you're 70 and older, you can use qualified charitable distributions. This is a tax-free donation to a charity directly from your individual retirement account.
And for those of us who are having to take distributions from our IRAs, that can be a wonderful tax tool to eliminate the taxes on those required minimum distributions.
If you can't donate cash this year, you can always donate your time. And remember, the best reason to donate is because you want to help out an organization near and dear to your heart. And that's a way to rip off a check and part with a few dollars. That always makes sense. I'm Keith Russell. See you next time.
Hard to believe with consumer prices what they are, but some experts suggest the country is heading for, or maybe already is in, a Goldilocks economy, just right. Financial professional John Lawton from Open Air Advisors joining us with this concept and how you can take advantage of the conditions it presents to improve your finances. Okay, good to have you on.
Thank you.
Let's talk about, there is a difference. When we've heard bear market. I don't know that a lot of people are familiar with the Goldilocks economy.
Goldilocks economy, if you remember this story, we had the porridge and one was too hot, one was too cold, and one was just right. So what we're saying here is that the economy, it seems, and experts are saying that the economy is just right.
What does that mean for the average person, for folks who are at home watching right now?
So if you're looking at your 401k statement, most likely if you own stocks or investing, your stocks have done well. Remember, NVIDIA had earnings the other night and the market's at all-time highs. If we own real estate, you've probably done really, really well. Really any asset classes have done well. When we look back at the grocery store, prices are still high, but they're not increasing or growing as much as they were a couple of years ago.
Okay, so how should a Goldilocks economy influence our financial decision making?
Really, it shouldn't. And I would just say that when I work with retirees and pre-retirees, and so really when we build a financial plan, we build it for the hard times. And we know the economy's cyclical. We have good times, we have bad times. When we build a plan or when we look at our finances, we want to make sure that we're prepared for those bad times. We don't want someone going out there and panic selling just because where we were in a Goldilocks economy, now we're in a much poorer position.
Okay, so what else should we do when the economy is good?
Right now, it's a great time to look at our savings accounts, make sure that we've got those 3 to 6 months worth of expenses set aside, make sure that the credit card debt is paid down. If you have done well and your job is going well and you're looking at your 401k, let's look at the contributions and what percentage we're putting there. If we're doing 10, let's go to 15. We always recommend somewhere in that ballpark of percentage of income that's going into the 401k on a monthly basis.
I'm guessing too, if your company does any sort of match, correct?
You always make sure you get the free money money. So that's the bottom line. Always make sure you're getting the free money, but I would say always go beyond that. Usually the matches in the, depending on the company, 2 to 3%, sometimes 6, but we really would suggest 10 to 15% for you to really meet your financial goals. We do retirement planning all the time, and when you look at the end result, when you look at where you want to be at 65 or 60 or whenever you want to retire, that's really helpful to go backwards and say, okay, I really do need to start now. I need to start investing today and really increase those contributions to those plans.
Because really you're just having to adjust a little bit. Because when you hear that, if you're only contributing 5%, the idea of putting another 5 is like, but you can adjust then.
Do it slowly. Sure, do it slowly. But, right now, if we're in a Goldilocks economy, a lot of folks have done really well in their jobs, and maybe you've gotten a raise, or those are great times to go back and look at it. If we have gotten a raise, go back and look and maybe adjust the earnings then. If you change jobs, a lot of times you get an increase in salary. That's a great time to boost those retirement savings.
Yeah, we don't want to work forever.
No, I want you to retire.
All right, so how can people get in touch with you if they would like more information?
Best place is our website, openairadvisors.com.
All right, thank you, John. Good to meet you.
Thank you.
Have a great day.
We are talking about inflation dropping, and will those interest rates actually go up? And what does this actually mean for us? I'm here with John Lawton from Open Air Advisors. John, don't mind us this morning. We've got a few little things going on here with the teleprompter, but we are talking about those interest rates dropping.
Yeah.
What do you think is really the big question that a lot of people have on their minds this morning when it comes to that? Are we in some sort of uncertainty?
Well, inflation's been dropping for the last year. In fact, inflation came in at 3%. This is the lowest reading we've had since March of 2021. So that's good news.
Wow.
Interest rates are starting to come down. Or I'm sorry, inflation is starting to come down. We'll talk about that here in a little bit. But this is good news. If we were talking a year ago, in fact, you and I did talk a year ago in June, and at that time inflation was 9%. Oof. And during that time period, over the last year, we've seen the price of gasoline go up, come back down. We've seen the price of eggs. That was headline news there for a while.
Sure was.
That's come back down. One of the sticky ones has been used car sales. And a year ago, when you and I were talking, that was 30% of that CPI number. Today, that's really starting to come down, and so that's one of those last things that we have to get rid of to get that number to the Fed's target of 2%.
Right, a used car was like super expensive, almost as much as a brand new one. So now they're going down. How might this affect interest rates, as you were talking about?
So the Federal Reserve is set to meet this month. We expect them to raise interest rates one more time, so 0.25% one more time. After that, we expect, and experts would agree, we expect interest rates to pause there. So that's really where we are.
And that's kind of some hopeful news as well. How could this affect businesses, both big and small?
Yeah, so I think the good news is with businesses big and small, obviously trying to plan for those longer term expenses has been really difficult in this rising rate environment. How are we going to finance those different things? As interest rates pause, that gives us a better idea for business planning, what that's going to look like. Most of us expect interest rates to start to come down over the next 6 months and a year. So if you're looking for some of that long-term planning, if you're buying a house, if you're buying a CD, I work with a lot of retirees, and right now, if we're talking about interest rates, if you were looking at CDs, the difference between a 6 month and a year, we're choosing longer right now. We'd rather keep those interest rates and lock them up as long as we can so that you continue having that. Most people would opt for the shorter term rate. Right now, there's no advantage for you going longer, whether it's a 6 month or a 1 year instrument. Rates are basically flat all the way across the board. So
you know your stuff.
Yeah.
You know your stuff. Before we go here, John, how can people actually protect their personal finances right now?
Sure. I think, and we've talked about this before, but making sure that we have that 3 to 6 months worth of savings set up, make sure that we are paying ourselves first. So we're contributing to those 401k plans, and we are paying ourselves first, making sure that we're getting all of that,
We've got that
free
saving money versus inflation there.
Yes, ma'am. So this is a budgeting technique, but cut down on unnecessary spending. One of the things I think is really interesting, do this for yourself, is look at all the subscription payments that you have. Ooh. And make sure that we don't have any of those unnecessary payments. Strategize your savings. Again, make sure that you're paying yourself first, and that we are making sure that we're contributing to those financial plans. Shop your bills, and that was one of the things that was on the screen there just a minute ago. Between the electricity bills or any of those others, just make sure that we're shopping those, that you're getting the best
aware of
deal.
what's going on.
Exactly.
All right.
And your consumers can do a lot of those things to help themselves monthly, keep up with their budget, keep up with their spending.
Okay, John, thank you so much.
Absolutely.
A wealth of information. We're going to be sure we get that on our website as well.
Great.
At WFAA.com. Thank you so much for joining us here on Daybreak. And coming up here, a very inspirational story that you don't want to miss. We'll be right back after this break. As we observe Labor Day tomorrow, a new survey finds more than half of Americans plan to keep working into retirement. It's called partial retirement, and they're forced into it these days as the cost of living has really increased and savings have decreased. We've got local financial professional John Lawton from Open Air Advisors joining us this morning to really talk about this trend and how you can avoid working during your golden years. John, thank you for joining us so early in the morning.
Yeah, thank you.
All right, so we're talking about partial retirement. I kind of gave an explainer on it, but what really is it?
Partial retirement is just maybe you're reducing your hours, maybe you're going part-time, or maybe you're working seasonally, but it's just a time period where you are continuing to work, but you're just doing it on a reduced rate.
Are there any, I guess, benefits to this?
Yeah, there's a lot of really great benefits for it. Probably the biggest one that a lot of people don't talk about is just being able to delay Social Security. For a lot of us, and a lot of us that are at retirement age, the average retirement age balance of their 401k is somewhere around $400,000. And so a lot of us, with the cost of living increasing, are realizing that maybe that's not enough money.
Right.
And so being able to delay your Social Security payment, you can delay it all the way till 70. Every year that you delay it, you're getting an 8% increase. So for a lot of folks, working partially is allowing them to delay that. It might delay your need to dip into those retirement funds for a longer period of time, allowing them to grow more so that you're on a better footing for full retirement.
Yeah.
And lastly is you get to keep your friends. One thing that a lot of people don't think about, and one thing that we see as we help folks retire every day, is retirement can be a big change in your regular life. Your friends that you see on a regular basis, that you see day in and day out, that's a big part of your social network. 1 in 3 retirees experience some kind of depression symptoms, and so doing this seasonal work, part-time work, being able to still go in and see those people can be a really great source of keeping you going during those retirement years.
That really is a good point to make up. My mom, she is a special education teacher. She's been teaching for 31 years. This year, she finally decided to retire. And I'm like, Mom, you're so lucky. She gets a nice, hefty pension. But I think she's a little sad right now. She's like, oh my gosh, I'm not going back to school this year. You know, what should I do? And I think she is looking for that.
Oh, she'll probably go back and sub. We see a lot of those folks sub. My dad was a Dallas policeman. He works at the fair. He works at the fair. He's been working at the fair for 10 years. And they go back. It's all of his policeman buddies. So I think it's great.
Now, I guess how can people, when they enter this partial retirement, feel a little bit more secure to say, okay, maybe I can let go of the second job?
Yeah, and there's some things to think about. I think we've got something on the board. So things to be thinking about are your Social Security earning limits. So if you're going to double dip, meaning take Social Security and partial retirement, just know there is an earning limit of $21,000. And that's only if you're earlier than full retirement age. So there's some rules that you need to be thinking about. Healthcare coverage. If you're before 65 and before Medicare age, is the company going to provide you health care, or are you going to be going on Medicare, or are you going to be self-funding that? Because that can be a really big cost. Last one is just tax increases. And let me just say, anytime we're working with retirement or we're looking at any of those things, we need to be focusing on those taxes in our tax planning.
You know, John, I'm actually really curious because you said that you're helping people retire every day. Is there like an issue that you're seeing right now with people that are trying to retire?
I mean, I think that there's a lot of folks that are, we've had some really crazy years in the work environment and in just socially in the United States with COVID and different things like that. And so there's been a lot of shakeups with a lot of companies, and we're seeing a lot of people make decisions, basically decide, I don't want to give these last years to these companies, and they're finding different ways to do it. So partial retirement, I think, is a great way for people to not fully retire. Maybe they weren't financially set up for that yet, but this is a great way for them to get their foot in the door, or foot into retirement, but still retain those relationships, be able to continue with those retirement plans for a little bit longer.
Awesome. John, thank you so much for stopping by, and great tips there. Very insightful. Thank you so much.
John Lawton is a financial planner with Open Air Advisors. He notes there's been two sides of the coin to this forgiveness. Those happy their loans are gone or dwindled a bit, and taxpayers unhappy they would be footing the bill.
There's no guarantee that something like this is going to happen in the future. So if you are doing some of that college planning, look at the loans that you're taking out for the degree that you're going to get, and make sure that those numbers line up.
And that's where John and Chad agree, both saying Biden's plan is acting as a Band-Aid to the real problem of rising secondary education costs.
Why is the cost of educating kids skyrocketed?
Okay, you know what that sound means. Welcome back to Daybreak Saturday. We're shifting to consumer news this morning. With rising costs and larger student loan debt, millennials' retirement outlook is less certain than older generations. But local financial professional John Lawton from Open Air Advisors says there is still time for them to catch up. John is joining us live this morning to share some strategies young adults can use to reach their retirement goals. Good morning to you, John.
Good morning, Matt.
All right, so based on your research, where are millennials at with their savings right now? What's the most common thing you hear from them when you're talking about retirement?
I mean, they're behind, and unfortunately they're behind. Like you said, inflation is the price of housing, the price of college has gotten them behind. Also, part of the research is that people are living longer, and so if you're living longer in retirement, it's going to take more dollars to get you there. The good news is you've got time. And so for those millennials who are out there who are a little bit behind, there's still time. There's still time to get back on track.
And just a dollar amount, what we're talking about here, a percentage of your paycheck, how much should we, the millennials or younger generations, be saving for retirement? What's a good round number that you should start with?
The good round number is 10 to 15%. But let me just say, everyone's situation is different, and the factors when you're going to retire, if you're going to retire early, what lifestyle you want in retirement. But a good number to shoot for, 10 to 15%.
And what can young adults start to do when you hear that number? What could they begin that track with in their retirement savings? And like you said, you got time, but 10 to 15%. I mean, do you start grabbing that from the paycheck? I mean, what's the strategy in trying to reach that goal?
Well, first off, make sure that you're getting all the free money. A lot of employers that are out there today will give you a match on the contributions that you make to your retirement. And so make sure that you are getting all of that match. I'm saying don't stop there. I'm saying 10 to 15%. You can save up to $23,000 in a 401k in 2024. So there's a lot of room to save money. But automate as much as possible. One of the reasons that we advocate for the 401k is it takes it out of your hands. You don't have to make a decision. That money never hits your checking account. It's just automated and it goes off, and you never have to make that decision. Inside a lot of 401k plans today, they'll actually automate the process of increasing your savings amount. So if you're saving 4% today, you can automate the process of increasing that amount every year. So maybe it's 4% today, 5% next year, 6% the next year. It's almost like you're tricking yourself into saving more for retirement. But if you don't have those options, maybe you don't work for a company that offers any of those plans, consider an IRA. There's both a traditional and a Roth. Traditional helps you on your taxes today. Roth gives us tax-free money in retirement. At Open Air Advisors, we help folks make those decisions on which, for tax reasons, makes the best sense for you, traditional versus Roth.
All right, that sounds like great advice, Mr. Lawton. If you want some advice or any sort of financial assistance, you can call Mr. Lawton here or any of their experts at Open Air. See, I didn't miss the plug. John Lawton, thank you so much for joining us this morning, and we will take all of your advice very seriously moving forward here.
Great. Thanks, Matt.
All right.
The Dow Jones plummeted 600 points today, triggered by an increase in jobless claims, leading to worries that we may be falling into a recession. Investors saw the latest jobs report, and it became obvious that the economy is starting to slow. The Fed has been trying to get that to happen for quite some time now in the form of higher interest rates. What we're seeing now is the result of that. So you're probably asking yourself, how could this impact me moving forward? Well, today I spoke to Jonathan Lawton, a wealth advisor with Open Air Advisors. He told me this might be one of those situations where bad news for investors in the stock market is actually good news for the consumer, especially if you've been thinking about buying a home but have been holding off because of those sky-high interest rates.
This might be one of those situations where bad news is good news. Again, this might give the Fed the flexibility to start lowering those interest rates. I think that in an election year, we should have volatility. This should be a year of volatility, and leading up to election, that's what we normally see. Probably we'll have an interest rate decrease in September. Now with this, that's making it look like it might be even, a bigger interest rate decrease than what others were thinking before, 0.25% versus 50 basis points.
Lawton also told me if you're investing in the market, hang tight and make sure that your portfolio matches the risk that you're willing to take so it can ride through perhaps a longer stumble in the market, one lasting longer than just a few days.
Biden is forgiving $20,000 to Pell Grant recipients and $10,000 to other borrowers, capped for borrowers who earn less than $125,000.
It's our understanding that you cannot apply for this yet. There's a website coming. One thing that I would say is just because you're getting a little bit of debt forgiveness and you're not having to make those payments today doesn't give us this isn't a reason to go rack up more debt.
Economists with the SMU Cox School of Business also speaking to this point.
So this debt forgiveness program might actually encourage future students to borrow more to fund their college costs, knowing that's going to be relieved later, which could raise the budgetary cost of the program even higher.
Taxpayers footing the bill.
Financial planners at Open Air Advisors say those benefiting from the payment pause or forgiveness should take this opportunity to make sure you have 6 to 9 months of savings on hand and pay off other debts like credit cards.
I think the biggest mistake you could make is going out and acquiring new debt. This is a gift. I think that we should all take it as a gift and make sure that we're doing the right things financially so that our financial foundation is more secure.
And the story has been very popular online all day long. To find out who's eligible or how to apply, go to NBCDFW.com.
Consumer news this morning. Tomorrow is Data Privacy Day, and tax season is a prime time for scammers to steal both your personal and your financial information. So it's really important to be aware and be vigilant as well. Joining us right now is local finance professional John Lawton from Open Air Advisors with some tips and some tricks to protect yourself from fraud. Good morning, John.
Good morning, Cleo. How are you this morning?
I'm doing well. All right. So what are some tax scams people should keep an eye out for?
Well, and let me just say, tax season is always a great time for us to think about these things. At the same time, we need to be vigilant all the time. But a lot of things, emails, texts, phone calls that you get, we need to make sure that, the IRS would never ask you personal information from a phone call, from an email. I got one the other day from my bank. It looked exactly like my regular bank account, and it said, click here to verify your individual information. One of the things that you can do anytime you see something like that, where the hair on the back of your neck's going up, is just click on the email address and see where it's coming from. A lot of times that can stop a lot of fraud. If you see something from the IRS, hit reply and see who that email is coming from. You might find out that it's not coming from where you think it should be. They'll never ask you that information. You should never, type that information into any of those emails or on the phone.
John, school me here. What do scammers want to do with my tax information?
Number one, they want your think about the things that are on your 1040, the things that you're filing, your social security number, your date of birth, all of your information. This to really terrible identity theft. At the base level is just getting your tax refund. At the worst case is getting your entire identity.
Not a good thing. Now, you have some ways on the screen right now in terms of preventing scams. How do we do so?
Number one, make sure that whatever Wi-Fi that you're on, that it's password protected. It's really great. We're in the cafe, they say free Wi-Fi, and if we're checking box scores or playing on social media, that's fine. But if we're doing anything where it's involving your credit card information, your social security information, filing your taxes, we need to make sure that you're on a secure network. Make sure that your software, your firewall is all up to date with the most secure firewall protection. And just make sure that your passwords are protected there as well. Anytime you see that where it offers two-factor authentication, I think that's a great way to keep people out of your stuff.
Yeah, great advice, John. And what should we do if we think our information has been stolen?
If you think your information has been stolen, immediately contact the IRS. I would also add to that, let's go ahead. If it were me, I would be checking my credit to make sure that something there hasn't happened. But contacting the IRS, I would start documenting literally everything that I can. And you might end up where if your information has been compromised, you might end up in a situation where you have to file a police report. So keeping those dates and times and everyone that you talk to in order can save you a lot of time in the long run. When this does happen, this can be a really time-consuming situation. So keeping anyone out of this situation is really a primary concern.
Yeah, definitely something you want to avoid. John, thank you so much for sharing your insight this morning. Thanks for joining us here on Daybreak. Welcome back. Father's Day is just a week away. When it comes to getting your dad the perfect gift, forget the tie, maybe the gift card. Why not give him what he'd really appreciate, a financially independent kid? John Lawton from Open Air Advisors is here with some ways to do that. Good morning to you, John. Thank you so much for waking up early.
Good morning. Yeah.
Okay, I think Dad might like the tie and the gift card and a financially independent kid, right?
Sure. Oh, yeah.
All right, let's talk about this. What did you learn, I guess, from your father and how that maybe shaped your life when it comes to financial literacy?
I'm still learning from my dad. He's still here. He still gives us the fishing tips. Unfortunately, I don't know that either one of us are getting any better at that. But I remember my first job, the first thing that he told me was start your plan, start saving early and often. My dad was a Dallas policeman for 37 years.
Wow.
And back then, when he started when he was 18 years old, and there were guys that he worked with that had to make that decision at 18 whether they were going to start a plan or not. And so as he continued to work and work and work, he saw some of the guys that didn't, so they get to the retirement age and they don't have a plan. Yeah, they don't have a plan set aside. So early and often, make sure we get it started just as soon as you get your first job.
And that can be a scary place to be when you're getting ready to retire and you're not set up for retirement. Let's talk about the Bank of Dad for so long here. What are some ways that we can actually show him that we're financially set?
Get the basics right. So make sure that you have your 3 to 6 months worth of expenses set aside. Make sure that your budget and your debt is in order. And I would say get organized with that, right? Make sure that you have those things set in place. And then make sure that you're contributing to a plan.
Makes sense. Let's talk about those strategies to implement when you pay off debt.
There's two major strategies that we use and that we see. The first one is pay off the highest interest rate first. So if you're looking at your credit cards, let's choose the one that has the highest interest rate. The other strategy that I tend to use and that tend to like is find the one with the lowest balance. With any strategy, make sure that you're continuing to make your minimum payments, but pay off the one with the smallest balance. And then use the money that you're not paying once that one's paid off to then move into the next one and then move into the next one. And so it really starts to build. If you're looking at your credit card debt and you're only making the minimum payments, you know you're not getting anywhere with that. So you have to have a strategy to make sure that you're getting those paid off.
Oh, that is a good strategy here. And how do we keep our savings on track? That can be difficult.
So just going back to the basics, right? If we have our 3 to 6 months worth of expenses set aside, you can handle a lot of obstacles in your life, right? I mean, if the air conditioner goes out or any of those sorts of things, that savings will get you through that time period. Now, if it's a job, that's a little different. And so maybe we do need to pause until we can get ourselves back on track. But every situation's different. Having that 3 to 6 months is a really good insurance policy on our lives.
Okay, that's a good one to always keep in mind. And John, I guess what advice do you have for dads that are still maybe helping their kids financially? I remember when my dad cut me off for good.
That's a tough
It
one.
hurt.
That one, yeah, that's a tough one because there are a lot of kids out there that really do
Yeah.
need help. And so I would say for any of those dads that are out there, try to transition and being the mentor. Try to transition from being the piggy bank into giving good, sage advice. And when you can do that and you can help them, the other thing I would just say, because we have a lot of families that do give money to their kids and they do it on a consistent basis. If you can stagger those payments, so maybe you really like to give your kids something special at Christmas time.
Yeah.
If you're doing that every year, they tend to depend on it. And then if that money were to go away, they made long-term decisions based on your gift. So if you can stagger that, maybe it's not a big Christmas gift, maybe today it's in March or June, that'll help them not rely on that payment, and so it really is a gift to that financial household.
Good advice, John. You know, sometimes people just need an advisor like you. How can they reach out to you and get that help?
The first place is a lot of the things that we've talked about are directly on our website, openairadvisors.com.
John, thank you so much for joining us. Always a pleasure to have you.
Thanks, Cleo.
All right, glad you were here.
Talking about family finances sounds like an awkward topic at Thanksgiving, but Jonathan Lawton from Open Air Advisors says it can be a perfect time, especially if older parents are gathered with you.
First off, you have everyone together. You have everybody usually there in person, and there's time to do it. After the turkey, after we've all eaten our fill, maybe the Cowboys game's on in the back in the back room, but that's a good opportunity. Everybody's together to talk about their finances, talk about their plans face to face.
Okay, so when you hear plans, you're like, okay, what topics are most important to settle?
Eventually, something's going to happen to all of us. So what is the plan? What is that going to look like? What do you want to happen? Where do you want your money to go, and those sorts of things? Number two, I would say, is beneficiary designations. You think of your bank accounts, all of your different accounts. Who is the beneficiary of those accounts? Because those are the ones that are going to transfer first. And secondly, who's the contingent beneficiary? So if mom and dad were to pass away at the same time, that money goes to somewhere else without it having to go through probate. The last one is just where is everything? So if we have a will, where is it? If we have accounts, what do they look like?
Okay, and let me just add too, ask them, where are your passwords? Where's the paperwork? You need to know where that stuff is too, so you're not having to hunt it down. And by that, he means talking specifically about keeping those electronic accounts. What about bills, right? Again, you need passwords for all that stuff. Do they still arrive in the mail? What needs attention now and later? Jonathan says, do not be afraid to broach the subject. Just be matter of fact and, of course, loving about it. So we are, of course, grateful for today. And for those around us, this is one way of showing all of them.